Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we're taking a look at ULTA Beauty Incorporated, ticker ULTA. Last looked at this one about a year ago. It's time to get those numbers updated. I know it was a decent growth stock last time we took a look, and I have it on the watch list. In fact, I own a little bit of it. I've been writing it up. So part of this is taking a look to see if I need to sell out or continue to hold, because this is a very volatile stock. I have bought in the 300s and sold in the 500s. I feel like at least twice. It's been a wild ride with this one. And I mean, the fundamentals are pretty good. The growth prospects are good, but boy, can earnings play a role on the valuation. I'm coming up with a fair value of a little north of 460. It's currently trading for 518, but then discounted cash flows coming up with 714, and for the retained income model, 551. So there's definitely things that show that it could be a little undervalued here, but we like to look across the company holistically and see how the balance sheet and everything else are doing. And I mean, they don't pay a dividend, so that's one factor that can't even value it based off of. But then the balance sheet's not the best. I mean, it's fine for its industry. In retail, 1.4 is not bad. You're investing heavy into inventory and stores and equipment, and you're likely selling at lower margins. That's why these stocks, I mean, a little bit of exposure is great, but I've started to trim them out of my portfolio, and I'm not really going back. Like, I used to own quite a few grocery stores, and I don't, when there's opportunities like this, or even better than this, there's Google's and Nvidia's and everything else, then I want to diversify a bit into different sectors and companies, but I want to weight heavier towards the companies who are better fundamentally, but also have better growth rates. And when it comes to retail, I think this is probably one of the better ones there that I will invest in. Earnings yield 6.05%. It's okay. So we're really looking for a earnings per share of almost $26 to be typically valued. And what we're getting out of it is north of that this next fiscal year at 26.97. So on an earnings front, not too bad. Earnings growth rate's 10%. PE 21, definitely fair for what you're getting for your growth rate. But your PEG, your price to earnings growth, is 2.05. So it's a little high. And I would say my valuation agrees. I'd like this stock at 450. South of 500 might be okay. 518 stretching it. I'll hold, but I don't know about buying. Except we have cash flow yield. Haven't quite hit double digits on average. We're looking at almost 10, 9.9. And this last year they came in at 8.5. So cash flows are down a little bit. We can take a look at overall dollar value. So they just finished fiscal year 2025. And I mean, it is down from 2023, 2024, kind of on a downtrend right now, but still up from 2022. So we will see how that plays out going into the future. Might actually prompt me to change this while we're talking about it. ROE looks really good, 48.3, but like we said, debt to equity is a little high. It's going to be skewing that. So we need to give more weighting to these other values. The return on investments, 21.65, incredible. And ROA, 20. So these are the kind of numbers I look for the companies that I want to invest in. I mean, if your assets, investments, whatever else are getting single-digit returns, when I have a company like this, I know that they're much more capital efficient. And it shows in the margins, 10.63%. It's exactly where we like to see margins at. You know, the gross is a little north of what I would expect, 38.84. You know, I'd expect it to be closer to 30. On average, they're about 39. So margins are high, or margins are decent, 11.4 on average, 10.6 this last year. With that gross, I mean, they could probably be a little higher, something more in the realm of 15%, maybe even 12.5 would be pretty reasonable here. But now we'll get into the thesis where all this growth is calculated from. Revenues, it's pretty easy, I feel. Over the last 3 years, we're 9% growth. Last two, 5.2. Analyst projections are 6.6 for this next year, and over the next two, 5.9. So somewhere in the realm of 6% looks like what analysts are expecting over the next 3 years. So we'll go with 6% there. Share count, massive on buying back shares. That's another thing that I love to look for companies. Like, they have all of the markings for a great investment at the right price. 4.5% share buybacks is just incredible. It's growing, so it looks like they're doing the same dollar value, which means you're probably looking at something in the realm of 4.5, 4.6% this next year and into the future, unless they decide to stop their buyback program. And in that case, they might start issuing a dividend. I don't think they need to at this point, not until growth really slows down. Once you kind of hit your peak as a company and things are leveling out, you're just above inflation for your revenue growth, and you're getting by on operations, maybe growing your margins a tad bit. That's where you issue the dividend to try and get investors in the door. But they don't need to at the moment. I had adjusted cash flows earlier to continue the downtrend. If this downtrend continues, let's see, 5.5%, then we're looking at 8.3% for their cash flow yield in 5 years, which still isn't bad. I'd really like to see them get above 10, but we just looked at the chart. They're on a bit of a downtrend right now. So 0.5% below revenue, this would be a more bearish. Assets, 5%. I mean, we see 8, we see 5.7. So, I mean, if you want around that, 8.6, we could get something in the realm of 4 to 5 if they continue at this rate. You know, the base is growing for their assets, so continued large growth is going to be harder. So even if they invest the same dollar amount, we're going to be expecting a bit lower assets. And liabilities, they're low. 2.9, 1.5. 1.5 to 2 is probably fair in here. You know, I could up it to 2. We are looking at a more bearish case at the moment. No dividend. Don't expect to start one. And margins, if we're going bearish, let's say they essentially hold flat, right about 10%. And what we're looking at here is annual growth of 14.75%. Incredible. You know, better than the 8 to 10 that you get from the S&P. Almost 1.5 times what you would expect from the market. But no dividend, and you're buying at a bit of an elevated price. 518, it's just not enough. With the fair value where it is right now, in 3 years, you'd be looking at a fair value of around $600, which amounts to 14% growth. So you're underperforming the market by about a year and a half at 12% below. And in the next 5 years, we're looking at the value growing up to somewhere in the realm of $730, where you're seeing growth of 41%, but you're still 6% under the market. So I would say it's not really worth buying at today's price. Like I said, 500 could be reasonable. I mean, you're essentially in line with markets in 5 years. And remember, this is the more bearish case. 480. Well, let's go 475. That's where I said that I'd probably really start considering it. And in 3 years, you're essentially in line with markets, and you're outperforming in 5 years by 7%. So that's why 475 would kind of be on the upper end of what I'd like to buy it for. You know, if you could get in at 450, kind of what I'm getting for the fair value, of course, you're sitting great with these returns. And for anyone who says, oh, you can't get into this for 450, it's been as low as 309 in the last 2 weeks and as high as 539. So like I said earlier, this one is a roller coaster. I've been on the ride multiple times. I buy in when it's low. When it goes up pretty quick. And then I get out anytime it's over 500 because I know, based off my calculations last year, that was just more than I really wanted. And that's a pretty large position if we're talking for a small portfolio, a few shares. $500 a piece is definitely a decent size. And if we wanted to go a little bit more bullish with that, I'll just change things that I had edited for that bear case. Again, share count, definitely reasonable, around 4.5, 4.6. Cash flows, I'd like to see them start to grow this. So if we go 7, which is 1% over revenues, we're now looking at 8.9 in 5 years. I want to get this above 10. So to get it up above 10, we're probably looking at something like 9%. It's just shy of 10. I feel like that's stretching it right there at 9%. This is a very bullish case. Asset growth 6, liabilities 1.5, and for both of those, I'm essentially just going with what we saw over the last 2 years. And margin growth of 0.5%. So this is the more bullish case. You're only really getting an extra 1% per year, which does add up. But if you're buying at today's price with the bullish case, you have slight outperformance in the next 5 years. And that's really what I'm looking at on this one. I will probably pick some more up if it drops below 475. I have a little bit right now, not a crazy amount. Probably 2 or 3 shares. But this is one where if I want the sector exposure, it's not bad. And if you've heard about one of the signs that you're in a recession, they call it the lipstick indicator, where women will cut back in spending on other ways and will invest heavier in makeup to try and make themselves look and feel better, I guess, is the justification there. But typically, one thing that sells better in recessions is makeup. So if you think that's coming, even better reason to get into this stock. And with the Fed cutting rates and it being because of the job market, it does not bode well. Price of gold is showing it. Lots of people think that we're headed into a recession, and lots of indicators show that we might already be there. So I want to thank you guys for watching. Please like and enjoy the video. Comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.